A digital euro for a stronger Europe? This is the question that drives everything we're about to explore. In a world where money has become a geopolitical weapon, can Europe afford to rely on financial systems it doesn't control? Is Europe truly free to manage its own payments? The answer, as well as we see, is more complicated and more uncomfortable than most people think. Europe's payment systems, its currency infrastructure, and its access to global finance all run, in large part, through channels controlled by others. Here's what we'll cover today. We start with the weaponization of money, how financial systems became tools of geopolitical pressure. Then, we examine Europe's structural dependency on foreign networks. We bring it to life with the case of Francesca Albanese. We look at China's digital currency as a model of sovereign monetary infrastructure. And finally, the digital euro. Europe's response. 5 topics, 1 question. Does Europe control its own financial destiny? It's February 2022. Russia invades Ukraine. The Western response is immediate and unprecedented, a full financial war. And at the center of all of it, a demonstration of how money, payments, and financial infrastructure can be turned into weapons. This is the 2022 sanction shock. The sequence unfolds quickly. In February 2022, Russia's invasion of Ukraine triggers sweeping Western sanctions. Just weeks later, in March 2022, Visa and MasterCard suspend all their operations in Russia, cutting off tens of millions of cardholders overnight. And today, that episode has set off a growing trend of financial decoupling across the world. Countries are asking themselves, what happens if this is done to us? Today, as digital currencies emerge, the question of who controls the infrastructure of money has never been more urgent. The risk is clear. Sudden exclusion from systems like SWIFT, Visa, or the US dollar is not theoretical. It has already happened. Europe's dependency on foreign financial systems is not something new. It's an historical bottleneck built over decades. From Bretton Woods to today, Europe has operated within a dollar-dominated international monetary system without ever building a fully autonomous alternative. This section examines exactly where that dependency lies. From 1944, global currencies were pegged to the US dollar. After 1971, the formal peg disappeared, but dollar dominance didn't. The emergence of the petrodollar system in the 70s locked in that dominance further. And today, the US dollar remains the undisputed anchor of global finance. Europe has never escaped this gravitational pull. The numbers are striking. According to SWIFT data from February 2026, the US dollar accounts for 49% of all global payment messages by value. The euro comes second at 23%, and the British pound third at 7%. When we look at international transactions, dollar dominance becomes even more pronounced, 57% versus just 14% for the euro. These figures show that international transactions are largely dollar-dominated. And in trade finance, the picture is even more extreme. The US dollar controls 82% of all trade finance messages on SWIFT. The euro and the Chinese renminbi each account around 6%. That means that when European companies finance international trade, they are overwhelmingly doing so in a currency and through systems they do not control. Meet Francesca Albanese, an Italian international lawyer, the United Nations Special Rapporteur on Human Rights in the occupied Palestinian territories. In July 2025, the Trump administration imposed personal sanctions on Albanese. The measures were announced by Secretary of State Marco Rubio. They included a travel ban to the United States, a freeze of any assets under US jurisdiction, and a prohibition of any person from engaging in financial dealings with her. And critically, Visa and MasterCard blocked her payment cards globally. Because both companies are subject to US jurisdiction, they are required to comply with OFAC sanctions. The moment she was designated, her card stopped working everywhere. And the consequences didn't stop there. European banks, including Banca Etica in Italy, refused to open accounts in her name, not because EU law required it, but because they feared losing access to US markets. This is what's known as self-compliance, institutions voluntarily aligning with US sanctions to avoid secondary consequences. The result, a UN official living in Europe effectively cut off from the global financial system by a decision made entirely in Washington. The Albanese case shows that European financial sovereignty is not just a theoretical concern, it's a daily reality. China's response to dollar dominance is the most ambitious monetary project of our time, the digital yuan. It's not just a payment innovation, it's a sovereign alternative, an attempt to build a monetary infrastructure the state controls, that doesn't depend on SWIFT or Visa, and that could, over time, reduce China's exposure to Western financial pressure. The ECNY matters not because it has transformed everyday payments in China. Private platforms like Alipay and WeChat Pay already do that. It matters because it gives the state a sovereign digital rail, one that is issued by the People's Bank of China that carries the same legal status as physical cash, and that operates under state control rather than through private or foreign players. The contrast is stark. On one side, SWIFT, Visa, MasterCard, and the dollar, the Western infrastructure that currently dominates global finance. On the other, the ECNY, CIPS, and Project mBridge, a multi-country CBDC platform involving China, Hong Kong, Thailand, and the United Arab Emirates. China is not replacing Western infrastructure overnight, but it is building the capacity to route an increasing share of global transactions through channels it controls. The digital euro is Europe's answer. It is a central bank digital currency issued by the European Central Bank, a form of public digital money that would give every European citizen direct access to sovereign currency in digital world, without depending on private banks, foreign card networks, or American tech platforms. The ECB launched the project in 2020, and the target for possible issuance is 2029. This is no longer a theoretical project, it is an operational one, with a deadline and a roadmap. Four core goals defines the digital euro. First, it will be a direct liability of the ECB. This means holding a digital euro is as safe as holding cash. Second, it will have offline payment capabilities, functioning even without an internet connection, just like physical cash. Third, it will offer enhanced privacy compared to current digital payment tools. And fourth, it will reduce reliance on foreign systems, no more routing European payments through American infrastructure. An effort by Europe to preserve a space of autonomy in a connected world. This is how the digital euro can best be understood. Not a revolution, not a replacement for the dollar, but a deliberate attempt to ensure that Europe, its citizens, its businesses, its institutions, has access to a payment infrastructure that answers to European law, European values, and European democratic oversight. The path ahead is long and uncertain. The digital euros faces real challenges like the risk of banking disintermediation, but the direction is set. Europe is building toward a sovereign financial infrastructure.